Some breaking news right now out of the New York Fed. Steve Liesman has that for us. Steve.
Morning, David. John Williams, the New York Fed president, saying he expects growth to slow considerably this year, unemployment and inflation to rise. He says the GDP slowdown comes from declining labor force growth as well as uncertainty as well as tariffs. Monetary policy, he says, in the right place to manage risk, though he adds, quote, as best we can. Here's his new outlook. GDP below 1% in 2025. That compares with being above 2% last year. The unemployment rate 4.5% to 5% compared to the 4.2% right now. And inflation 3.5% to 4%. That's the concern right there. He says a key question is, does higher inflation this year spill into future years? And we're getting a lot of that concern from the Fed about when inflation from tariffs would work through the system. He's watching right now how the global economy responds to changing trade policies. Earlier this morning, Alberto Musalem from the St. Louis Fed said if inflation expectations become unanchored, they have to prioritize fighting inflation. That's another theme many Fed officials have struck. Tariffs, he says, will dampen activity as companies rethink supply chains and consumers face higher prices. One more thing, Kashkari on our air from Minneapolis saying recent market movements show investor preferences could be moving. I think that's a euphemism, guys, what we've been talking about. First of all, are what we're seeing as a general sell America idea here? How firm is that right now? As well as the notion of what would break this? An announcement from the administration about another change in tariff policy. But maybe, Sarah, something very much in your bailiwick, this idea of how central banks globally respond. Would there be a need for some form of global central bank coordinated action if things started to get a little messier? And what would be the willingness of other global central banks to coordinate with the United States at this juncture?
Well, right. That's a question right now, especially for the Fed, which is watching the bond market, as they always do. What would it take for them to intervene?
Okay, so one of the interesting elements of what we're going through right now compared to, say, the pandemic or the the great financial crisis is that the Fed has several liquidity facilities that are up and running. It would not have to make an announcement, for example, of the creation of a dollar swap line with the ECB because one already exists. The Fed does not have to create a standing repo facility for additional liquidity because one exists. One person I talked to, Sarah, put it this way. There is no rate put from the Fed, but there is perhaps a liquidity put from the Fed. People won't run out of money, won't run out of dollars if they need them. So there isn't that concern out there. The issue, though, becomes all of these things moving at once and how disruptive all of this could be in terms of the positioning of different hedge funds, different banks. It is a positive, perhaps, that we go into this with high levels of capital at the banks and a lot of the banking reform that was done post-great financial crisis, that could be helpful to what we're seeing. And while we're not hearing right now at this moment of the kind of disruption to the financial plumbing that we might have expected or did see in other situations.
Well, wait, so Steve, I mean, to the extent that, and again, here it's somewhat conjecture, that Scott Bessent walked into the president's office a few days ago and said the bond market is telling you we got to do something here. And the result was rolling back the tariffs. Did that not work?
It did and it didn't, David, right? I mean, what was the actual reduction in the tariff, right? When you figure in the new China tariffs, the estimates that I've seen saw several small single-digit decline in the total average tariff rate for the United States. So there was an announcement. It did appear to work. I guess you're asking a question that's beyond me. Maybe you know, maybe Sarah knows, but it's a political question of where is there a Trump put? I think what you're pointing out is there does appear to be one at some level to some extent. But maybe you're right that there is another thing where Scott Bessent could walk in and say, Mr. President, things are appreciably worse than when we talked last Sunday, and so you need to do more here. I will point out that the short headline from what Neil Kashkari said was, Mr. Trump, do a deal with China, and then we can figure out monetary policy.
I think it worked in the stock market, but not in the bond market.
Right, but to the extent that we all believe the bond market was the motivating factor here, it doesn't seem to have reversed
It hasn't reversed the bond market
higher in
decline.
yields.
And we know that that is what this administration is targeting. So it does raise the question of what else we'll get from the administration if they are worried about the confidence factor in selling bonds.
I would just point out, guys, it worked only for a day, right? You had a huge rally.
Sure, but we're still higher than where we were where we started the week.
But what's your metric, Sarah?
The
question is, what's your metric? We're still way down from where we, not way down, but we're still well down, I would say, from the Liberation Day.
Oh, no, we definitely haven't come back, not even close. We're, 15% off the high still on the S&P, 19 on the NASDAQ. So that's where we are right now.
I would add just one thing, which is that one investor told me that it could be that the possibility of just what you guys are talking about is stemming potential losses here, that you would be afraid to be markedly short in this market if there's some possibility of another White House announcement.
Yeah, it just doesn't take much. It takes one post, as we know, in terms of the equity markets. But again, I think, as we have been rightly focused, the bond market is perhaps more interesting now in terms of what it's saying.
I'll make just one more point, guys, which is that at some point, right now, I think you're right, David. I don't know for sure, but I think you're right. It would take one person. At some point, things can move along that it becomes beyond the ability of just a single person, as in the president, to turn this thing around. That's really where I think you would get nervous if it would require something like either a single or multiple central bank intervention to stop this thing from careening. And I don't think we're there at this point. You want to be very careful about talking about that. But right now, I think you're right, David, and I hope you remain right.
Well, it's going to be another working weekend for everybody on the phones. Thank you, Steve.
Thank you, Sarah.